What's going on, everyone? Okay, I'm just going to say it. The US has decided that in order to subsidize home buying for high-risk buyers, they will be giving a discounted rates to them at the cost of borrowers who have great credit and are financially responsible. Wait, what? Yes, you heard right. Lower rate for higher risk borrowers at the expense of high credit home buyers. How does that even make sense? Well, let's get right into today's article that I picked up from the New York Post titled How the US is Subsidizing High-Risk Home Buyers at the Cost of Those with Good Credit. A little noticed revamp of federal rules on mortgage fees will offer discounted rates for home buyers with riskier credit backgrounds and force higher credit home buyers to foot the bill, the Post has learned. Fannie Mae and Freddie Mac will enact changes to fees known as loan level price adjustments, LLPAs, on May 1st that will affect mortgages originating at private banks nationwide from Wells Fargo to JP Morgan Chase, effectively tweaking interest rates paid by the vast majority of home buyers. So beginning May 1st, this will go into effect, essentially making mortgages even more expensive than they already are. But let's see what others are saying about this. It's going to be a challenge trying to explain to somebody that says, I worked my whole life for high credit and I put a lot of money down and you're telling me that's a negative now? That's a hard conversation to have, one Word Arizona-based loan originator told the Post. It's unprecedented, added David Stevens, who served as the Federal Housing Administration Commissioner during the Obama administration. He said, my email is full of mortgage companies and CEOs telling me how unbelievably shocked they are by this move. And I am as outraged as they are. The audacity and the insult to those who work their lives on having pristine credit profiles and finances. I mean, why even strive for good credit and financial responsibility? I believe this is a huge slap in the face to hardworking Americans that make the sacrifice to put their families in the best positions to grow. And by no means am I saying forget about being responsible with your credit. It's just very upsetting that they're doing this, in my opinion. In my opinion, I believe we need to do a better job as a country teaching financial literacy and positive financial habits as a mandatory requirement in any educational establishment, just like they require you to learn history. But let's continue reading. The tweaks could further complicate the strenuous mortgage application process and add more pressure on the core segment of buyers in a housing market already in the midst of a major downturn, the experts added. The average 30-year mortgage rate is hovering around 6.2% as of last week, up 5% from 1 year ago, and more than twice as high as it was 2 years ago, according to Freddie Mac data. Under the new rules, high credit buyers with scores ranging from 680 to above 780 will see a spike in their mortgage costs, with applicants who place 15% to 20% down payment experiencing the biggest increase in fees. So now, to add more insult to injury, not only if you have high credit score will you be getting quote-unquote penalized, but also if you put 15 to 20% down payment. This makes absolutely no sense in my opinion, at all. But this is what Stevens, who is also a former CEO of the Mortgage Bankers Association, had to say about this. This was a blatant and significant cut of fees for their highest risk borrowers and a clear increase in a much better credit quality buyers, which just clarified to the world that this move was a pretty significant crop subsidy pricing change. Point blank, period. But what are LLPAs, loan level price adjustments, and how do they work? LLPAs are upfront fees based on factors such as borrower's credit score and the size of their down payment. These fees are typically converted into percentage points that alter the buyer's mortgage rate. Under the revised LLPA pricing structure, a home buyer with a 740 FICO credit score and a 15 to 20% down payment will face a 1% surcharge, an increase of about 0.75% compared to the old fee of just 0.25%. Think about it like this. Things are about to get more expensive for those home buyers with great credit and a higher down payment. When absorbed in a long-term mortgage rate, the increase is equivalent of slightly less than a quarter percentage point in mortgage rate. On a $400,000 loan with a 6% mortgage rate, the buyer can expect their monthly payment to rise by $40, according to calculations by Stevens. Now get a load of this. Buyers with credit scores of 679 or lower will have their fees slashed, resulting in a more favorable mortgage rate. For example, a buyer with a 620 FICO credit score with a down payment of 5% or less gets a 1.75% fee discount, a decrease from the old fee rate of 3.5%. So if you're someone with a credit score below 679, then congratulations, you will now have a better chance of getting approved for a mortgage, and it will be relatively more cheaper. Putting this into perspective though, when absorbed in a long-term mortgage rate, that equates to 0.4 to 0.5% in discount. Now, the FHFA ordered overhaul of LLPAs affects purchase loans, limited cash out refinances, and cash out refinance loans. The revamped pricing matrix also includes a controversial addition of a new charge for buyers with debt to income ratios above 40%. A convoluted measure that drew immediate pushback from the Mortgage Bankers Association and the industry groups who warned it would be difficult to implement. So on top of mortgage rates constantly on the rise, home prices not stabilizing or dropping, they are now going to make it even more expensive for strongly positioned buyers looking to get into the market. After the pushback, FHFA announced last month it would delay the rollout of the debt-to-income ratio fee until at least August 1st. A move said it would ensure a level playing field for all lenders to have sufficient time to deploy the fee. So once again, expect the LLPA fee changes to take effect on May 1st. Now, the timing couldn't be worse, and that's exactly what Pete Mills said, a senior vice president of the residential policy at the MBA, to the New York Post. The timing of this is troubling. As we start to hit the spring home buying season, home purchases are demonstrably impacted by the rate increases over the past year. The timing is not ideal. And I couldn't agree anymore as we enter the heaviest season of transactions in real estate, spring and summer. The article mentions, most borrowers are likely to see a modest increase as a result of the fee changes, according to Mills. Asked about concerns that the changes will hurt high credit buyers, an FHFA official told the Post the agency was tasked with ensuring Fannie and Freddie fulfill their role in any market condition, adding that shifts in long-term mortgage rates are a far bigger factor in determining finance conditions in the U.S. market. The latest recalibration to the pricing framework that FHFA announced in January 2023 is minimal by comparison and maintains market stability, the FHFA official said in a statement. You sure about that? You sure about that? Look, bottom line, in my opinion, I don't believe that this is a smart move to implement right now. And I truly sympathize for the hardworking people that bust their ass off to get to where they're at, only to be hit with this insult and slapped to the face. Whether we like it or not, it's set in motion and going to happen. So with that, let me know what your thoughts are about this. And please, share this with as many people as possible, so the more that you stay informed, the better financial decisions you will be able to make right now for you and your family. Thank you for watching, and I'll see you guys on the next one.